Hello and welcome to this special webinar from Fat Profits as the bull market arrived. It's got the lips moving, people are talking, bull market versus bear market. So we've got a lot to say today. Thanks for your company. My name is Roger Malik, the Head of Client Services. And joining me today in our discussion on the markets is our Senior Account Manager, Chris Balafas. Chris, welcome to today's webinar. How are you?
G'day, Roger. Yeah, good, thanks. Nice to have so many in our webinar today. So we look forward to providing a bit of macro for the listeners today.
Yes, there's a lot to talk about. Hopefully, by the end of today's webinar, people are a little bit more informed from Fat Profits research. So all the best with today's information session. Before we get into the presentation, usual housekeeping, all our presentations from Fat Profits are general in nature. We don't provide any personal advice. If you're looking for that, please see your financial advisor. And also past performance is no indicator of future performance. And today's webinar, because we have a lot of people, in fact, we've got close to 400 people watching it at the moment, probably a few more joining in a bit later. If you have any questions about what we are discussing, feel free to type them in on your screen and we'll answer those questions throughout the presentation. All right, let's go. First thing first, Fat Profits. Follow the herd or hunt it. That's one of our logos, and we certainly like to hunt rather than getting hunted. We're a little bit contrarian in nature, which means we can go against the crowd sometimes, and you're going to find out a little bit of that today. So Chris, first up, over to you to talk about 2022 versus 2023.
Yeah, well, that's the question. How does 2023 compare with last year? As we can see, bit of a dark market last year, Roger, other than the FTSE over in the UK. But so far, 2023, despite all the volatility, we have seen the markets do actually quite well. And this is the whole reason of this webinar. Is it going to hang around? And we'll show a few indicators as to where we feel the markets will be as well.
Yeah, absolutely. Look, Nasdaq's been the big play this year. As you can see, 26% up versus 33% down last year. The tech stocks, and we're going to talk about that as well today. On the other hand, ASX, a little bit down last year, a little bit up this year. So we're actually pretty much flat versus last year. Not too bad. You'll take that in a bear market. Now, I guess one of the big questions for you as an investor is, what camp are you in? Are you bullish about this 2023 and beyond? Are you bearish at the moment, or you're not sure? You're open to, I guess, information from the market to decide. So give us, and here's a question up on your screen, give us your feeling of your position at the moment. Are you feeling more bullish at the moment, thinking the worst is behind us, or are you still bearish that maybe the worst is in front of us, or you're not sure? So give us some numbers. I think we'll be able to share that with you in about 20 seconds, and we'll make it interactive. So let's have a bit of fun today in this webinar. We'll make it interactive, ask some questions, send us some feedback, and let's have a bit of fun. Okay, so we got some numbers come through. Let's have a look. So far, the people who voted, we've got 29% saying they are bullish. Okay, interesting. We've got 47% saying bearish, and the others are neutral, as you can guess. Okay, so still more cautiousness in the camp today. Well, what's Fat Profits thinks? We are going to tell you in a moment. But first, Chris, tell us what the bulls are looking at the moment. So there's certainly a few things to...
Yeah, so 26%. Interesting with the poll. So these are the reasons why investors would be bullish. With these 5 points, we've had the US debt ceiling finally going through. AI has been a very big talking point, especially over the last few weeks, Roger. We've got the better earnings versus expectations, strong labor markets, which we've been seeing, and also the big issue, the elephant in the room in the US is obviously the slowdown in inflation, and obviously where the US want to get it down to as well. So that's a lot of the reasons why people are bullish at the moment.
Yep, absolutely. Fair few things for people to talk about. Look, at Fat Profits, we do believe that the bull market is coming. There's no question about it. However, we don't think the bull market is here just yet. We're going to show you in a moment, but it will come. It's a matter of when, not if. Let's start with the US first. So, of course, recently you've seen the US national debt pile up over $31 trillion, and they've recently struck a deal to raise the debt ceiling for another 2 years. So that's been done, thankfully, because now we're not going to see a contagion. However, the one thing which the markets really look forward to is corporate earnings, and this is the engine which drives the share market. So far, if you look at the S&P 500 earnings over the first quarter till fourth quarter of last year, it's been declining with rising rates. The recent first quarter, which is just almost completed, we saw a bigger earnings decline than previous quarter, but it was actually not as bad as it was expected. So that's part of the reason why the stock markets are up this year. But second quarter earnings, the expectations are that it will be the biggest drawdown in corporate earnings. So that will be the most keenly watched quarter, because if it is as bad as expected, then we can see the markets come off. The expectation for the next few quarters is on the rise. So there is growth expected over the next few quarters. We're not as bullish as this chart suggests, as consensus seems to believe, but time will tell. Next up is non-farm payrolls, jobs added in the US. And recently we've seen huge number of jobs getting added versus expectations. So this really continues to prove the labor market is strong. The unemployment percentage has ticked up in the last month, but still, look, it's pretty sticky. 3.5, 3.6% as an average over the last 12 months is not really moving. Even though rates have gone from 0% to 5%, the labor market is the last shoe to drop at the moment. It's very, very hard to move. So it's frustrating the Federal Reserve. The US inflation, yes, it has come down from its peak of 9% down to about 5%, but it is proving to be harder to come down from here, very slow. So that's something the bulls don't like. On the other hand, Chris, the bears, what are they liking at the moment, or what are they looking for?
Yeah, so that was just a taste of the bulls, but the bears, as we can see in our image, the bear off the cliff, you could say. So the weak markets, the volatility we see in the markets, Roger, a hawkish Fed rate height. So they're still thinking, well, they're going to keep going up. And the third one's an interesting one, sticky inflation. So that again is interest rates going up, banking crisis. Where do they find the middle? We've got credit tightening, inverted bond yields as well. So a lot of indicators as well for the bears, thinking that it's still going to be a weak market.
Very good. So one of those, and we'll highlight a couple for you now. One of those is the S&P 500 breadth, and you can see that in a very long-term chart from 2005 to now. That really simply means is the number of companies out of the top 500 which are greater than the 50-day moving average. In other words, they were rising. At the moment, it's the exact opposite. The total S&P 500 breadth is falling, which means it's only dominated by the top 10 companies. Here's another chart of the S&P 500 breadth. At the top in the black is the S&P 500 grinding higher, where at the bottom you've got the breadth, and you can see the breadth is actually falling. And that's typically not what you would expect in a bull market. Normally, when a bull market, the share price is rising, so is the breadth. In fact, at the moment, it's exactly the opposite. Share price is rising, breadth is falling. So that's, in our opinion, is another indicator that this is not a bull market. Core inflation, as Chris said earlier, is sticky. Yes, it's come off from its peak, but it's proving to be sticky around 5.5%, 5.6%. Year on year. So that's something that the Fed wants to really bring down. Otherwise, the Fed have already anticipated that they will be looking at a mild recession towards the end of this year. That's the Fed saying. The market at the moment is expecting to avoid this recession. Now, in the past nearly 100 years, the Fed have raised rates in a hiking cycle 14 times, and out of those 11 times we have ended up in a recession. And you can see 3 times we've seen a soft landing, which simply means we've avoided a recession. Now, the odds are certainly not in the bull's favor. the bears would win this argument. And at the moment, we have seen one of the most anticipated, or I would say probably one of the biggest hiking cycles the Fed has ever done, gone from 0 to 5 in a matter of 15 months. So the odds are certainly in the favor of the bears. Leading economic indicators index is also pointing down in the negative territory. You can see the blue line. The red line is the real GDP, and that usually follows, which brings a recession. You can see that in previous recessions where the gray bars are. So this is also pointing towards the bears case. Another thing which is pointing is the inverted bond yield curve. This is basically the difference between the short-term bond yields versus long-term bond yields. And when that goes negative, we have seen recessions, which are the tall gray bars. At the moment, we're quite deeply inverted, and this is a 100% proven indicator of an upcoming recession. So these are things that the bears are looking at. The final thing here is the rally this year has really been through the tech stocks, and these are the big tech stocks. And this one really proves the big tech currently is trading at a 37% premium to the market, which really simply means it's getting more and more expensive. And prior to this, the only other 2 times it has been as high was in 2007, before the 2008 crash, which is a gray bar, and 1999, before the tech stock really went through an absolute tear, followed by the dot-com bubble. So tech now is really getting quite expensive, and this really proves that here, because if you look at the S&P 500, which is the top 500 companies in the US, you look at the purple line, which is the 7 stocks, namely Meta and so on. They've risen combined 44% this year to date, whereas the S&P 500 has risen 10% year to date. And here, wait for this, the remaining 493 companies are only up 1% this year combined. So this proves that this is a tale of 2 halves. In fact, the 7 companies have done 43% more than the 493 companies. This is not a sign of a bull market. Chris, over to you. Looking at the S&P 500, yes, it looks like short-term trend is moving higher. What's Fat Profit's expectation for later this year?
Yeah, so listeners, with just those indicators, the leading economic indicators, the inverted bond yields, the tech valuations, the S&P has been doing well. But with all this, with a mild recession on the horizon, we can see the markets dropping in the S&P. So we're around the 40, 41, 4,200 at the moment. So we can see there's a technical level around the 34, 3,200. We're not saying that's the bottom, but that will be a clear indicator for us, Roger, that there might be a great time to start dollar cost averaging, getting back into the markets.
Sure. So in other words, we're looking at least a 20%, maybe up to 25% drop from current levels to bring it down to these 2 orange lines. That's what our research suggests. And once it gets down to that, we'll be looking to buy. Now, why is that? Another indicator which points to that is the bear market phases usually goes through in 3 cycles. The first and the second are usually mild, but Chris, the third and the final one is usually the most strongest, the most violent. And we're looking at about 24% drop as an average.
Yeah, interesting chart, this one. So most of the losses occur, as Roger said, during the final innings of the bear market. So once we see the markets correct, there will be quite a fast correction, Roger, is what we usually see historically over the last 90 years. And again, that's just going to give us an indicator that it's going to be the right time to start looking to get back into some of these stocks at a cheap price.
Absolutely. All right, let's have a look at what that will bring. So market volatility, something you shouldn't be afraid of if you plan well, creates investment opportunities, and that's what we're looking for, is opportunity to make some serious money this year. Moving on to Australia, let's have a look at what's happening down under. Well, one of the key things, if you look at inflation here, is been driven by population growth, and this chart really proves that the blue line, which is the annual population increase driven by migration, has skyrocketed, and the orange line, which is the houses completed is dropping. So we're seeing a decline in new houses coming on board, and the population is increasing, and that's putting upwards pressure on rents, upwards pressure on cost of living, and still the property market is starting to rise again, which is what the RBA don't want to see. Well, partly thanks to a huge influx of migrants coming in now and even planned for the next 2 years. And this really proves that as well. And you can see a big difference between 2020 when it was all declining and now the floodgates have opened. So what does that do to the economy? Well, currently the inflation is starting to move back up, which is the exact opposite of what the RBA want to see. It was trending higher for the last 2 years, it was starting to come down, and now it's ticked back up. Another little example, you can see that their inflation was coming down and now it's ticked back up. So that's not what the RBA want to see. Now, Chris, on the ASX, as we talked about at the start of this webinar, we've gone down a little bit last year, gone up a little bit this year, but we're pretty much going sideways if you look at the last 2 years. What's our prediction for the ASX?
Yeah, so we have told our members, and we just showed you today, where the S&P will be, and also closer to home. So you're right, the markets have been a little bit annoying. They've been treading sideways, but again, as you can see that support level there, we're looking at around 6,400 on the ASX. So at the moment, it's doing quite well around the 7,200 mark. It is up and down quite a lot, but again, that's just going to be a nice indicator for us, Roger, our analysts. Not to throw our firstborn in, but we're certainly going to be looking at it as a good opportunity.
Yeah, absolutely. So this is certainly something to keep an eye on. Moving on, we are going to ask you the second question for today. This is something we're going to share our thoughts on. But when you decide to buy or sell a stock, how do you do it? What makes you decide to buy or sell? So this is a multiple choice question. You don't have to answer one. You can pick all 5 or 2 or 3. But be honest, because we really want to know what people think and what kind of audience we have today. Because we are going to share how Fat Profits does it. And you can compare the notes to see if we're on the same page or maybe we are completely different than how you do it. So we'll give you 30 seconds to answer, pick a couple of choices, and let's get some interaction going. In the meantime, I've just received a comment from Jonathan saying, hi guys, I've seen a couple of your webinars in the past, and I totally agree. I'm sitting on about 35 to 40% cash, and I'm waiting for a drop, and I'm in the bearish camp. Okay, Jonathan, thank you. Let's see. Time will tell. Look, we do our research, we make a plan. Well, of course, we've got to stick to the plan. So all the best to you. Okay, we are done. Let's close it. Okay, so we've got quite a few mixed responses. I won't go through all of them, but the interesting thing is that most people, just having a look here, most people have chosen at least 2 options. Some have gone with charts or market volatility, etc. Okay, so we're going to share with you what we do at Fat Profits. So first thing first, Chris, over to you. Who are Fat Profits? What do we do?
Yeah, so Jonathan probably knows who Angus is, and probably a few of you listeners as well. So, well, we've got a whole team of fundamental and technical analysts. Angus is our CEO. As you can see, you've probably seen him on television. At 17, he turned $200, Roger, into 35,000, and has never looked back. He's been in the markets ever since. We love him. He's a Kiwi, maybe not when the World Cup rugby's on, but he just gives us a bit of an idea of what's happening. And since then, and since probably inception 2000, he's now managing 200 million. We have a London office, an Auckland office as well. So yeah, he's the brains, and he gives a bit of an idea to our members, Roger, as to where he's putting his money in the markets as well.
Absolutely. So we do the stock market research. Just to clarify, we're not stockbrokers, so we don't manage your money. You manage your own money, but we provide a subscription service where we do the research, provide that to you, and you can pick the brains out of us. Moving on to David. Now, he's our mining analyst. So, Chris, you've been working with Fat Profits for how long?
So I've been here for 12 years. I spent quite a lot of that time in the London office. But again, you've probably seen David. He's the face of Fat Profits. He's our in-house geologist and resource analyst. So when it comes to small caps, medium caps, large caps, Roger, in the mining sector, in the precious metals, David is the brains, and he provides the research behind that, behind his team as well.
Yeah, very good. So that's a lot of experience there. But the other thing is we put our money where our mouth is. So we also manage real money. Angus is a fund manager, and he manages over $200 million of real money. And he's got different model portfolios where he puts that in and he manages and watches that. So this is an example of our Australian portfolio, which was initially launched in 2007. The orange line is our Australian portfolio, off to a slow start because we went straight into the GFC. Not great timing, but it is what it is. But post that, this orange worm has really gone further and further away from the S&P 500, sorry, the ASX 200. So we have nearly tripled the ASX returns over a very, very long period. Nothing to sneeze at. These are real money, real dollars that people have invested in us, and we're providing a very strong return for them. So this is something we're very proud of. But here's the question which we asked earlier, is how do you decide to buy and sell a stock? Well, you got to have a plan. You can't just one day wake up and feel like, oh, well, this stock has dropped 10% today, let me just buy it. Well, there's more to buying and selling a stock. So one thing to look at charts and look at technical analysis. We also look at everything that we put up on the previous question. We look at all of that, whether it's earnings for that stock. We look at PE ratios, price to book, dividends, are they increasing or decreasing, the debt levels, management. We'll do a full fundamental analysis of every company before it passes through a series of checkboxes, and then it becomes a buy or a sell for our members. So this is what we get paid to do, is to do every bit of research that we can before that becomes a plan to make some money. And this is how our current plan looks like in this bear market. So staying defensive is part of the plan. Raising cash levels, as Jonathan rightly said earlier, he's got plenty of cash. Avoiding speculative stocks in this bear market, and staying patient. This number 4 is very important. Staying defensive. How do you stay defensive? What does that even mean? So looking at companies which have low debt ratios, high current ratios, low debts, stable earnings, good dividend flows, and they're, if overall you look at the previous history, how they performed in turbulent times. So that's a defensive stock right there. A few examples right in front of you. You probably know some of these names. These are good quality defensive stocks in today's market. Now, as an example, how many of you have heard of this company, Spark New Zealand? Probably I'd say 70-80% would say, I've never heard of them, right? But Chris, this is a star performer in our portfolio, very defensive, but more than doubled over 10 years.
Yeah, and basically, I mean, our New Zealand office members would know these guys really well. But yeah, absolutely, Roger. Defensive, basically, listeners, they're the Telstra of New Zealand. So we've got them at $2 about nearly 10 years ago. And I love that little point there. We're only giving this as a guide, but you put $10,000 at that price, whereas we can see it now, we've made 123% on a very large company, Roger, $8 billion market cap, and they pay a 5% dividend. So that's the kind of defensive stocks we like to tell our members when to buy and when to hold.
Absolutely, and keeping in mind that they pay good dividends of 5 to 6% a year. So we've been collecting that every year for 10 years. On top of that, we've more than doubled our money. So this is something as a defensive stock, just to give you a simple example of what that can do, and there's a very less drawdown. Now, second part of the plan is cashing yourself up. Now, we cannot state this enough. Don't get a FOMO and get sucked in by this current bull market within the overall bear market, because the final real bull market is coming, and for that, we are ready. Angus has gone on live TV many times over the last few months, and he has told the whole of the country that he's sitting on about 25 to 30% cash as a fund manager, and he's contrarian. He's going against what the market is doing right now, and he is waiting and waiting and waiting, and he'll be ready to buy when the time is right. So if you are a member, we will provide you the daily and weekly research to keep you up to speed. Number 3 is avoiding speculative stocks. They're getting crushed in this market. There's no question about it, and that's what happens in a bear market. 4th and final is staying patient. Now, this is important because it's a very slow moving market. This is what typically happens. It doesn't all happen in a heap. So here's an example of many of our stocks which are currently on hold. Hedge means hold. We're waiting to turn them into buys when the time is right. Now, on the other hand, Chris, talk to us about the income report that we publish every quarter, because some people watching this webinar today might be interested in just dividends because they might be retired or looking to retire, and dividends become a very important part of their portfolio.
Yeah, well, patience is the key, isn't it, Roger? So we've got an income portfolio, listeners, which is a guide for our members to identify what stocks are we recommending as buys or even holds that are the defensive stocks that Roger was talking about earlier, where we keep the risk at a minimum, and we're looking for strong yielders. So this report comes out every 3 months, and we've just updated it. So we've just got a few. We can't show them all, but we've got ANZ as an example there, Nine Entertainment, Spark New Zealand, which we just spoke about. So this is just giving us a bit of an idea as to how many stocks we're looking at, and the bottom right will give you an idea. So for the last 10 years, we've been consecutively getting a return of 13.7% in such a volatile decade, which we're very, very proud about this income portfolio.
Yeah, absolutely. And keep in mind, the number one thing in this portfolio is these 21 stocks are all defensive in nature. And this is the key for those people looking to protect your capital, but still wanting dividend, because here's an example of those same 21 stocks that we can't show you the names of, but a couple of them we have, is a dividends per share, financial year 23, financial year 2024, and the net yield for every stock for both these years, and the gross yield, which includes franking credits, and which stocks are fully franked and unfranked. Now you can see some stocks are paying in this financial year gross yield of upwards of 9-10%, which is fantastic. Some are paying 6-7% as well. But the overall portfolio average, you're looking at this year 6.3%, and next year 6.5%. That's just for dividends, and growth is certainly on top of that. So Chris, if you're a self-funded retiree and you're looking for, 6-7% dividends a year, well, there's no better place than this particular portfolio.
Exactly, and the last column will tell you that a lot of them are fully franked. And in fact, some of those property stocks that we got there are trading below their net asset value. So you're currently buying these companies at a discount, and they're paying you for the property ones from 4 to 8%, which is, just an incredible return. That's just the yield.
Yeah, good. All right, so this is something you'll have instant access to if you join our membership, and you will be updated on these stocks on a regular basis. Moving on, let's talk about some growth stocks now. Well, one of the key sectors for us which we like is gold, and now not only gold shines bright, but it looks fantastic when you have that in your portfolio and it starts moving well. It's really tied to the US dollar, Chris. Now, can you tell the listeners today what is the relationship between the US dollar and gold?
Yeah, well, if you don't know, they basically compete with each other, Roger. So at the moment, we have seen the US dollar being strong for many, many months. As we can see in this chart, great example. So the general investors, they're confident in the US dollar, and then you will see the gold price go down. But obviously, with everything that's happening with America, and as we show with indicators, if America does go into that recession, the US dollar will weaken, and then we'll see the gold price in US dollars increase, as we can see in this chart. So it's at roughly around 1940 at the moment US an ounce. There's a target price of over 2,200. So there's a lot of opportunities at current prices, Roger. If you get in early, you're actually going to reap the reward.
Yes, our forecast, you're right, Chris. Our forecast currently points to $2,200 to $2,300 gold price before the end of this year. So there's another few months to make some money, and we think the opportunity is right here, right now. One of the stocks we're happy to give away today is a company called Evolution Mining. And if you want to write this down, no worries. Chris, this is not a stock that we're only just bought recently. We've had it from very early days at 20 cents.
Yep. So got in early before the general public. A good example of dollar cost averaging. We've held it for quite some time, all the way back in 2011, and we've just put it as a buy again, as you can see, starting from the $1.80 around the start of this year. So a good example, again, just as an example, $10,000, where it would be today. We know, listening to our members, people put in a lot more. Evolution Mining, if you don't know, completely debt-free, very cheap gold excavator. So Roger, when they're digging out gold very cheap and you've got the gold price going up, their profit margins only increase and they're debt-free. So they just continue to use that money to reinvest in the company, and the share price, as we can see, has been doing very, very well.
Yeah, very good point. So early bird catches the worm. But look, even if you bought it recently at $1.80, just only a few months ago, this stock has doubled in a few months. So there are opportunities within a longer term trend. And look, there's nothing to stop this stock from going higher. As long as the gold price remains pretty strong, we're expecting the share price to continue. So if you pick that as a free stock from us and you make some money in the next few months, well, you're welcome in advance, because we are quite positive on gold. So this is one stock you can check out. But look, a $10,000 investment there would have doubled in a few months. So if you had joined us, and if you watched these webinars in the past and you didn't join us, if you had, you would have paid for your subscription already in a few months. So this is a good example. But look, there's more stocks here. This is a hidden gem, Chris, which is a junior producer of gold. They've only started production last year, while the share price has come off from its recent high, the 45 cents. But at 15 or 16 cents, this is looking quite appealing. Tell us why.
Yeah, early bird catches the worm, Roger. So this is, you could say, the little brother of Evolution Mining. So we've been recommending this stock for some time. And actually, we had some members take some profits around the 40 cents. But as we've explained, we're in there for the long term, especially if we can see gold going up. These guys, again, completely debt-free. Cheap gold excavators as well. I mean, just for argument's sakes, Roger, if you buy them currently at 16 cents with $10,000 and they go to where they were last year at 45, that $10,000 is $28,000. And we're not even going to be selling at 45. We're actually going to continue to hold it. So this is actually one of our highest conviction buys at the moment.
Yeah, absolutely. So look, if you want to talk about this stock, or there's many stocks like that we have, we certainly encourage you to consider becoming a member with Fat Profits. But more on that later. Let's move on to sell recommendations. But not only we tell you when to buy, but the hardest thing in the market is knowing when to sell. Now, recently, we have sold a stock called Mincor, which was in the news, as you may have heard. MCR, they're a nickel producer out of Western Australia, and they caught the eye of Andrew Forrest's company, Wyloo Metals. Now, if you've not heard about them, Wyloo Metals made an offer to buy out Mincor at $1.40 per share, and this was the offer. It has gotten extended till 5th of July, which will be the last day for the expiry for this offer to be finished. Now, what's happened to the share price? Well, you can see that on the charts. We got into Mincor in about 2020 at 74 cents per share, which is good time because the stock was starting to form a nice little uptrend. So we got in there, did all the research, and from that point onwards, the uptrend was maintained to a very high level of $2.80. Came off due to multiple factors, but now they've actually just been finalized. So we've sold the stock at $1.40, more than doubled our initial buy, but we've also, managed to buy it a few times between 74 cents and $1. So we're dollar cost averaging. So this has been a good story. And we've got many sell recommendations like this, where we buy and sell within 2 to 3 years. Another stock is in lithium, and most of you would know lithium has been a very hot sector over the last 2-3 years in the ASX. Now, lithium has a phenomenal rise from 100,000 up to 600,000 per ton, and this is crazy, 6 times in a year, unheard of. But post that, it has dropped, and now it's stabilized a little bit. So what's happened to some companies? Well, maybe we can talk about Allchem, AKE. Chris, this AKE used to be the 5th largest lithium producer in the world, but recently they've gone into a merger with Levant, which is already a big producer over in the North America, and now they're combining to become the 3rd largest lithium producer in the world. So this is certainly good news for anyone who's holding it or in that space. What are your thoughts?
Yeah, great. Whether we like it or not, Roger, lithium is here to stay. Electric batteries. So we've always liked Alkane. We've held them. I think it's quite a long time. I think 2020 we first got in, Roger.
Yes.
Well, there's a chart there. So yeah, these guys. I mean, look, a low PE ratio at the moment. We've just got them on a hold at the moment, but as you can see, dollar cost average for the last 3 years, massive lithium producer. And again, $10,000 back then, only 3 years ago. Well, now you're up 890%. And by the way, listeners, we're not selling them. We're just holding them at the moment, and there might be another opportunity to actually get back in.
Yep, very good. So even last month, if you watched this webinar last month, which we did, this stock was trading at $11 or $12 at the time. So we had suggested to put that in your watch list, not to buy, but just in case. I mean, you might have noticed that it's now gone up to 15. So certainly nothing to sneeze at. These stocks are moving even in a bear market. Now, before we talk about something else, let's have a quick look at some of the changes we have made to Fat Profits. One of those changes is that we've got highlights in our daily emails. So every morning, Angus, our CEO, writes a market update email to our members, and that email has got highlights right at the top. So if you're a busy person, you want to catch the main news from overnight, then you can just quickly look at that. Next up is we've done 2 webinars per week this year. And the last year we used to do 1 webinar per week. We've actually gone double that this year. Both webinars are at 12 p.m. Mondays, we do stock webinar where we cover 10 stocks. And Thursday, we cover the macro webinar with Angus, our CEO. And as far as we know, we are the only service in Australia where a fund manager comes and talks to his investors live every week and explains what he's doing as a fund manager, buying or selling, stocks, sector, and he provides his views. Now, this is a unique service where we don't know of anyone else where the fund manager really talks to their investors live every single Thursday. So that's something that you can look forward to and learn from, but these are recorded as well, so you can replay the recording. This is a panel of our, sorry, Chris, you were going to say something?
No,
all good, okay. This is our panel of people who've been coming along to these webinars, a lot of experienced people. You can see myself there and Chris in today's webinar, but we've got Angus, Patrick, our COO, who've been with the business for over 20 years. David, we talked about many of our staff who've been with us for over 10 years, including Chris himself. So there's a lot of experience there. We also do real-time daily publishing for stocks. And we send you daily emails in where we talk about buy, hold, or sell. It might be a couple of stocks each day, but we provide you updates. So if you see a stock like this, maybe Collins Foods, and you really want to be reading this, you can click the link and you can form an opinion and read the report. So every day, 2 or 3 stocks, and they come to your email. Midweek alerts. Chris, over to you.
Yeah, midweek alerts our members really appreciate because they don't have the time or inclination to know what's happening all the time, Roger. So we'll send out, if something happens quite quickly that you can't forecast, we'll send out a midweek alert. And just so our listeners know, since April, we've actually sent out 8 midweek alerts to let our members know that a few stocks have gone up and if action is needed. So we keep our members up to date so they don't miss out on anything.
Well, talking about missing out, if you are busy during the week and you're not looking at the market daily, look, on a Friday, we send you a reminder email, which is called Fat Wrap. It has all the articles that we publish during the week with links, just like that, and you can click, or recordings of the webinars, and if you missed out on a particular thing, you can just click that. All that is in the one single email. This is a really good reminder email on a Friday. Another thing we've changed is we provide a lot of technical analysis in our stock updates. So here's a quick look at a couple of charts of Whitehaven Coal and Rio Tinto, and you can see some support and resistance lines, some moving averages, some breakouts, and we identify them for you so you don't have to do it yourself. So all that is provided daily and weekly. And lastly, the sell recommendations. And this is probably the Achilles heel for an investor, because the hardest thing in the world is to sell at the right time. So we provide you sell recommendations, just like Mincor we looked at earlier. Here's an example of our recent sell recommendations in the last 12 months. And yes, while we make a reasonable amount of fat profits, but we take some losses as well from time to time. Look, we're very open and transparent. Anything we sell or buy, we publish that. So 7 out of 10, we get them right, but a few we do get them wrong as well. So just bear that in mind. Now, question is, what's ahead? Are we ready to take advantage of opportunities that are coming? Because let's face it, a bull market is coming. It's just a matter of time. But when it does come, boy, you've got to step aside, just like these men here in Spain are trying to step aside and make way. You have to. One of the reasons why, history will tell you, when the bull market arrives, typically at the end of a bear market, you normally see a 36% jump in the index the following 12 months after the bear market finishes. 36% jump in the index. That's massive. If you can get in right at the bottom, you could make a significant amount of money. I mean, on $1 million portfolio, you're looking at $360,000 in a year. Nothing to sneeze at. But even if you're 1 month early or 1 month late, you're still looking at 21 or 27% increase in the index alone. So there is a bull market coming. Now, for those of you who are long-term investors, you would know this very well, that if you watering your plant on a regular basis as a long-term investor, you can see that grow, you can see the plants coming, and you can see the tree blossoming. That's what long-term investing is about. There are certain rules that you have to follow, and some of those rules are very, very simple, but we're going to remind you today. Now, only risk what you're able to lose, so invest accordingly. Reinvest those dividends to earn more shares if you're looking for growth, that is. Invest in the things that you understand. If you're not sure, like Bitcoin or cryptocurrencies, don't touch it. Diversify amongst different sectors and markets. Don't put all your eggs in one basket. You've heard it. Create a plan and stick to it. Whether it's dollar cost averaging, buying many times, or waiting with some cash at the moment to get close to market bottom. And finally, avoid panicking during sell-offs. You know, history will tell you things do bounce up. So if you hold good quality stocks, they will come good.
Can I just mention, Roger?
Sure.
In that last one, avoid panic selling. Listeners, there's probably been stocks in your portfolio that you didn't know what to do. Rather than just panic and sell it, or sell premature, the beauty about our service is you can call Roger and I, or account manager, ask the analyst, hey, I'm holding this stock, I don't know what to do, get a second opinion. It's still your decision, but at least you can cross-check it with us, and then you can make a better decision so you don't actually end up selling the wrong stock.
Yep, very good point. Now, long-term investing has some absolute wonderful benefits. One of those is right here in front of you. If you haven't seen this, pay attention to this, because these are the best performing stocks in the S&P 500 over the last 15 and 20 years. So it's a longer term time frame, but boy, these returns get me excited. On the left, you can see the last 15 years, the top 20 stocks in the United States. Netflix, number one, 7,647%. That is huge return from this giant of a company. Number three, you've probably heard these names, NVIDIA recently, the chip maker, right? You look at Apple down the bottom, Amazon, Domino's Pizza, Monster Beverage. These are some household names that you probably use Apple products, you probably use Amazon, Google all the time. Domino's Pizza, who knows, you may even bought their pizza in the past. But look at their returns. I mean, astronomical. You look at the right-hand side now, last 20 years, this is unbelievable. Apple, 61,000%. Now, even if you invested, just do some maths for a moment. If you'd invested $10,000 in Apple all those 20 years ago, that would be worth $6.1 million today. Now, why is that significant? Because what we're highlighting here is buying good quality companies and holding them for a very long time. This is what makes people rich. This is wealth. And you can do this yourself or you today for the next 5 years, 10 years, 15 years. Or if you're maybe a mature adult, maybe you have grandkids or kids who are young, you may even buy 1 or 2 or 3 good quality stocks today with that view. This could change someone's life. This may change some of your lives. But the other final point in this is also think about investing in the US market. How many of you have ever thought about investing there? Some of you may have, because US is really, let's face it, the biggest economy in the world. And these kind of gains are very hard to find in Australia. So it's important to diversify, even if it's 2 or 4 or 5 stocks, but have a think about them because they're real and it is real money. Chris, any points from you?
Yeah, and again, we just put this slide in here just to reiterate. We're not day traders. We're in there for the long term. Again, going back to evolution mining, we're in there for the long term because we want to build wealth. And if again, and Roger said it, if there's a profit needed to be made, we will make it. But again, listeners, we're just highlighting the fact that long term patience always wins in the stock market.
Yeah, absolutely. So hopefully you got some ideas from that. Now, how's your portfolio position at the moment? Have a think about it, look at it, because it needs to be well diversified. You need to have good quality stocks across board, and the cash levels, as far as fat profit's concerned, we think that's going to be the component which will take your portfolio higher next year. Because if you can buy at the bottom, and with that cash, well, your portfolio is going to be looking very different next year. We can anticipate that. Now, we are going to also show you a couple of examples of other members who've been posting some reviews about fat profits. If you want to learn a bit more about what other people are saying, then go to productreview.com.au. It's an independent website, and you will find many such reviews from our members, good and bad. Look, we're not perfect. We haven't got 5-star, right? It's 4.2. But we haven't got 1-star or 2-star. We're not terrible either. So we're pretty good, but we're not, 10 out of 10. So most members are very happy. Some are probably not, but majority are very, very happy. So Dave Campbell here from North Queensland, been with us for more than 10 years, 15 years. He's just extended his service. Now, we've got some very good news, Chris, for people watching this today. In fact, I'm looking at my screen now. We have about 480 people watching it now.
Brilliant.
Just under. Yeah. So the best investment, Warren Buffett says, that you can make is an investment in yourself. The more you learn, the more you earn. So how can people make an investment in themselves? Maybe fat profits could solve one of the problems in the stock market for them. What can you tell us?
Yeah, so again, you still make the decisions, you still manage your money, but we give you the research. So again, if you bought and sold everything that we've provided in the last 2 decades, we average 16.7%. Again, if you don't have the time and inclination on the fundamentals and technicals, members and listeners, then we do all that for you. And as we've seen, we've got the experience. A lot of the members are very happy with how we work. And again, out of those 22 years, we get 7 out of 10 right. That's pretty amazing with what we've gone through in the last 2 decades, just providing our members with what's happening, when to buy and when to sell. Something that we never do is we don't cross market or upsell. Once you pay for the service, which we'll highlight soon, you get all of the research, you get all of the recommendations. And as we mentioned earlier, we put our money where our mouths are. So we basically manage money here, which again, if you come on board, you can see our portfolios as well.
Very good. So what's the good news? Well, end of financial year is here, and this is the time when we usually offer some crazy deals. So if you're looking for a good, solid deal, value for money, something which will help you improve as an investor, learn, educate yourself, and make some serious money, well, consider this. We have 3 types of memberships: standard, premium, or platinum. Now, with any of those 3 memberships, you get the first 3 benefits are exactly the same. Daily Fat Chat market commentary, so that's a daily email that Angus sends. It has a whole lot of information for you every day. You won't miss anything else. This is all you need. The weekly webinars. This is the jewel in the crown of Fat Profit Service. Our webinars stand apart from the rest of the market. We do twice a week, which no other company does. Both are recorded and live, and you hear from the best minds in the industry twice a week. Third is the reminder email Friday Fat Wrap that gets all the action that you might have missed out on during the week. It's all put in bullet points for you on a Friday. Now, the key difference in standard, premium, and platinum is the difference between the 3 portfolios. So the first portfolio is Australasian equities. Chris, can you tell us about the 3 portfolios, please?
Yeah, so that is the main report, the Australasian equities. So we cover the small, medium, and large caps. It also comes with that income portfolio that we mentioned. Global mining, well, 90% of them would be in Australia. So you got your precious metals, your golds, your lithiums, your nickels, your coppers, and then you got your global equity. So a little bit earlier, Roger was showing and highlighting the returns in the US. So the global equities will cover Asia, the London office. So we've got the UK, Europe, and the US markets as well. So in the standard, you choose one of those portfolios.
Okay, so standard, you get one of those. Premium, you get 2 out of those. So plus you get an account manager. So this is our most popular bundle for Australian investors. They usually pick the Australian equities portfolio and pick the mining portfolio. So those 2 you can pick if you're an ASX investor, plus you have an account manager. And platinum, if you want all 3, which means if you're looking at investing in the US or overseas markets, as well as Australia, then this is the one for you, which in one-stop shop gives you everything, and you have an account manager. So what's the damage? Well, here it is. So the offers are absolutely crazy. It's the end of financial year. Chris, can you explain the offers to us, please?
So yeah, if you're just looking for one report, it might just be the Australasian equities with the income portfolio, and you're going to want to do it yourself. You can just pay the standard fee, Roger, but you can get it for 2 years. Brings down your annual rate. Again, the longer you're with us, we're in there for the long term, then you can get it for $595 per year for 3 years. The premium, as Roger said, most of our members would be on, because that gives you everything in Australasia. So it gives you the ASX, the mining report as well. So you pay the 1 year fee, you get it for 2 years, only $995. Again, if you want it for 3 years, the annual rate comes down. Plus it gets you a premium account manager. So maybe Roger, myself, or one of the seniors, you can phone in, ask questions, get the advice. But again, it comes down to your decision. Same thing with the platinum. Sorry.
Yeah, go on.
With the platinum, if you were looking to invest internationally, or you already are, then platinum's definitely the option for you. Again, 2 years, 3 years brings down your annual rate, and as it says that they can be tax deductions because you're paying for consultancy. You just got to speak to your accountant. But again, it's a matter of choosing, the 2 years or 3 years, and that's where you'll get someone like us where you can speak to as well.
Okay, Chris, well explained. I'll just add a couple of points to say. One, guys, end of financial years here. Most of our members claim this as a tax expense. So we will give you an invoice, and this is the best time to do so, but obviously speak to your accountant for the tax advice. But the second thing is we have tried to bring these prices down to under $1,000 per year for premium. Certainly 3 years is under $900 a year. That is cheap as chips. If I can invest, this is an investment in your future earnings, less than $900 a year, and I can secure myself a reliable and trustworthy source of income, well, this is a fantastic way. As Warren Buffett says, invest in yourself, learn, and you will earn. So I'd encourage everyone watching this right now to give that a serious consideration right now. And we've got the question up on your screen now. So tell us, out of those options, which one would you like to join today? The standard, premium, or platinum? If you have any further questions and you want to talk to us, you can also tick the final option. But Chris, we have something special today to announce for the first 10 people, because this is the craziest month of the year for us. We are going to be super busy, but look, it's good news. So if you've got the finger on the pulse and you're ready to make a decision, you want a little bit of a push, and we want to give you an incentive, well, what is it, Chris? Pull out the steak knives.
Yeah, end of financial year. I can see already quite a few click in, Roger. You can probably see on the premium. So for the first time ever, what we're doing is for just the first 10 participants who click on standard, we're going to take $100 off on the 2-year or 3-year, depends on which one you choose. Which sounds like the ones that are interested in the premium. If you choose premium for the first 10, we're going to take off $200 on one of those fees, Roger. And the platinum, we've got approval. If you choose the 2-year or 3-year, we're going to take $300 off. But again, that's just for the first 10 ones that are interested. But otherwise, the end of the financial year offers are right there on your screen.
Great. So what we're basically saying is not only the offers are already cheap as they are, but if you want to make a decision now and join us today, just click on one of the options and we'll take 100 off standard, 200 off premium, and 300 off platinum straight away. So this is incentive on top of incentive. I love it. Look, we're getting quite a few questions come through. I'll take a couple of them quickly while we're getting our inquiries, and we'll wrap it up today. So the first question is coming through from David, and he's saying that, can I get my self-managed super fund to pay for it and make the invoice under the super fund, please?
Yes, you can. So we had it on our screen a little bit earlier. So when you come on board and we set you up with it, we'll just take down your super fund name and then we can send the invoice in the super fund name. So not a problem. Good question.
Great. Next one's from Karen. She's saying, I used to be a member with you many years ago, and I've watched a couple of your recent webinars. I really enjoyed today, and I think now is my right time to consider joining. If I join premium today, can I upgrade to platinum later? Because I like the idea of investing in US. So I'll quickly answer that for you, Karen. Yes, you can. You can take the premium 3 years or 2 years today, and we'll lock you in with that deal if you're the first of 10. However, if you want to upgrade to platinum later, then whatever the difference is between the normal price. This promotional price is only today, but the normal price difference is $600. So you can just pay an extra $600 for 1 year at any time. But if you want to lock in the cheaper rate, well, you're going to have to choose premium or platinum now. But hopefully, either or, it's not going to be a big difference. We're getting a few comments come through, but I'll take them later. I'm just going to close this screen now, guys, because we're getting towards the end of today's webinar. We get enough responses now, and let's close it. All right, here's the deal in front of you again. If you're still thinking about it, the 3 years on standard is under $600 a year. 3 years on premium is under $900 a year, and platinum 3 years is just under $1,100 a year. Very good prices. And on that note, look, we'll respond to those questions which have come through later on. I will say that if you have any further questions or email, you can call 1300 881177 and ask for Roger or Chris, or you can email info@fatprofits.com.au. My name is Roger. Thanks for your company today. We hope you enjoyed the webinar. And if you've got some information out of today that you found useful, please let us know, and I'll pass it on to you, Chris, for your final words.
And thanks for everyone joining in today's webinar. If you have any questions, look forward to answering them and speaking to him. And it was nice to do the webinar with you too, Roger.
Okay, excellent. Bye for now.